A ping from a Telegram group, a notification from a news app, a rapid refresh of the brokerage account to check the latest red arrows. The daily life of an average investor is loud, reactive, and intensely focused on what the market is doing right this second. Today, anyone with a smartphone has access to more financial data, charting tools, and zero-fee trading platforms than the most well-funded hedge funds of the 1990s. Yet, despite this massive technological advantage, the vast majority of retail participants consistently bleed money or severely trail the broader market returns. The math is unforgiving because of the specific game they choose to play. They're trying to predict what a highly volatile stock price will do tomorrow, next week, or next month, based on headlines and momentum. The top 1% of investors completely ignore that game. They don't look at a ticker symbol and wonder if the line will go up on Friday.
They look at a company's profit margins, debt, and competitive advantage, and ask if the entity will earn significantly more money 5 years from now. They buy actual, functioning businesses. To build real, enduring wealth in the markets, you have to unlearn almost every natural instinct you have about buying and selling. You have to flip the standard playbook completely upside down. When looking at a new investment opportunity, a standard investor usually asks one question first: how much can I make? The elite investor looks at the exact same opportunity and asks, how much can I lose? Their absolute highest priority is capital protection. Before a single dollar is deployed, they actively hunt for points of failure. They scrutinize the industry for signs of slowing growth, review the management team for past mistakes, and check the balance sheet for dangerous levels of debt. Elite participants treat every potential trade as a set of shifting probabilities. While the average investor hunts for a sure thing, the professional knows that every position carries a range of possible outcomes. Let's map out a scenario. An underlying business has a 70% chance of a 20% gain, but a 30% risk of losing 10%. By multiplying outcomes by probabilities and adding them together, the expected return is a positive 11%. You don't need a crystal ball. You just need to systematically allocate your capital into scenarios where mathematical odds tilt in your favor, while avoiding any situation that carries a risk of catastrophic ruin. Anchoring decisions in probability provides a logical defense against market volatility. While it doesn't eliminate the sting of a down day, it ensures the investor remains focused on the mathematical thesis rather than the temporary movement of the ticker. That anxiety usually drives a compulsion to act. There's an assumption that staring at charts and executing trades every day generates substantial returns. The reality is often the reverse. The highest performing portfolios often sit dormant for months at a time. The owners of those portfolios spend 50 hours reading annual reports, listening to earnings calls, and analyzing competitors for every single hour they spend clicking a buy button. This extreme patience is tested during a severe market correction. When major indices plunge and portfolios bleed value, most people panic and sell off perfectly good assets simply to stop the emotional pain. The 1% actively look forward to these drops. They deliberately build up cash reserves during stable periods, precisely so they have capital ready when the rest of the market is retreating. But they remain highly selective. A terrible company with its stock price cut in half is still a terrible company. They use the widespread panic to acquire deeply discounted shares of high-quality businesses, specifically those with strong cash flows, pricing power, and low debt. A bear market is a highly efficient mechanism. It takes wealth out of the hands of reactionary, emotional actors and directly transfers it to the patient and prepared. Instead of chasing erratic 50% spikes, the top 1% prioritize a consistent growth rate that can be defended over years. While high double-digit returns are difficult to maintain, even consistent, moderate growth creates a massive divergence from the average investor's performance over time. Consider a baseline of 10 lakh rupees. If an investor achieves an exceptional 20% annual growth over a 30-year horizon, the curve becomes nearly vertical. By year 10, it hits 62 lakh. At 20, 3.8 crore. By year 30, it transforms into 23 crore. While a 20% return is a world-class benchmark, the principle remains. Time and consistency are the primary drivers of generational wealth. Securing that kind of growth requires evaluating your decisions based entirely on process over outcome. A foolish gamble can occasionally turn a profit. And a well-researched thesis can sometimes result in a short-term loss. You evaluate whether the underlying facts were correct and the risk was controlled, regardless of what the stock price did that week. It ultimately comes down to one clarifying question. If the stock market closed today and you could not sell your shares for the next 5 years, would you still be happy owning this company? The path to mastery starts with understanding the underlying business mechanics and allowing compounding to function undisturbed by short-term noise. By managing the downside and staying patient, you let the math of the markets do the heavy lifting for you.